The 3% yield for the U.S. Treasury 10-year note is a magnet. Back in the spring of 2018, before the trade war escalated, the 10-year punched above 3% and then fell back. During the summer, the U.S. Treasury 10-year had a good chance to punch through the 3% yield barrier again, but it was held back by escalating U.S.-China trade war rhetoric. It's like the 3% level is a magnet, but we can't quite lock it in. Arguing for higher yields, we had a very strong Q2 U.S. economic growth number, 4%. We've got sub 4% unemployment rate. These kind of data, that keeps the Fed on track for 2 more rate rises in 2018. Corporate earnings growth are very healthy with only a few exceptions, really good numbers. What the 10-year note really needs, though, to get it moving higher is convincing data that U.S. core inflation is unambiguously on a persistent upward path. That has not happened yet. Now, inflation is definitely creeping higher. It's just not persistently, it's not a strong path, it's just a creep. Now, what has held back the 10-year from seeing higher yields? First, the escalating U.S.-China trade war has some market participants building defensive bond positions. Global growth may be slowing a little bit, and that dampens long-term inflation expectations. The Fed's guidance toward higher rates worries some who now fear a recession in 2020 as the yield curve flattens. Based on our analysis of the current shape of the yield curve, we're already at the point where the probability of a 2020 recession has risen above 33%. Finally, and this is a huge factor, there is plenty of competition in the fixed income world from exceedingly low-yielding Japanese and German government bonds. In the 10-year sector, Japan's bonds are yielding only 10 basis points, and Germany's bonds are yielding 40 basis points. U.S. Treasuries occupy the high-yield territory for major industrial country notes and bonds, and so they're attracting capital flows. For the U.S. 10-year, it's a fascinating tug-of-war with 3% as the magnet. I'm Blue Putnam, Chief Economist, CME Group.